Joining us now on the markets and the Fed, John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management. John, good to see you.
Great to see you, Mike.
So the worst day in 4 months is only a 1.6% loss. We should keep that in mind. We're less than 2% from all-time highs in the S&P 500. We haven't had a 3% pullback in 3 months. So that being said, it suggests the market, had a pretty aggressive appetite for continued good news, both on Fed potential easing, on a soft landing on the economy, on earnings coming through. Where does this lead us if we're not getting a March rate cut? Powell seems pretty satisfied with the state of the economy.
Thanks, Mike, for having me on the show. I got to say that, when we look at this, Powell is Powell, and he's an attorney. He always adds the disclaimer. If he says the Fed is achieving its goal as it moves forward and things look positive, then he'll add the fact that perhaps not. And the market has had rose-colored glasses, we would say, in terms of expecting a cut in March, expecting 5 to 6 rate cuts. We don't buy that. We're the club 1 to 2 cuts this year, probably. Now, earlier we thought towards the end of the year. Now we're thinking more like probably mid-year. It could start as early as mid-year, but it might be later. But it's a second half kind of story.
Yeah, I mean, we were already around 50-50 for a March rate cut. We probably maybe built up the degree to which the market was dependent on that, because now it doesn't seem like it's going to happen. Not long ago, a month ago, we were 80% for a March rate cut, and stocks have hung in there. What do the earnings trajectory tell you, though, right now? Because, it's a little noisy. In general, we're getting a pretty decent beat rate, but some guidance has been a dampener. And, of course, we're waiting for some big ones later today.
Well, I think, for the year, I think just as we approach the earnings season really beginning to open before the banks, I think FactSet was looking for about 1% growth, maybe 1.6% earnings growth in the fourth quarter earnings season. Right now, that looks like that's what it perhaps will be, but revenue growth is about twice that right now. And the concentration of the negative earnings growth is in energy, materials, and healthcare. Technologies earnings growth, when I looked this morning, as of yesterday's close, up about a double-digit, 15%. And communication services, which is about 50% tech, it was about 25% earnings growth. So really tells you that things are a lot better when you look under the hood.
And you're on the more bullish side of things when it comes to your S&P 500 forecast for the year. I think you're at 5,200.
That's right.
And you're only forecasting 1 or 2 cuts, excuse me. So you don't think that the markets need to have significantly lower rates in order to move higher?
Melissa, we don't think we don't think it's higher for longer. It's just staying at the end of free money for longer, and by that we mean with the 10-year Treasuries somewhere hovering today about 3.8, 3.9%, down from just about 5% just a few weeks ago. We'd have to say that the Fed this cycle may actually have its cake and eat it too, in the sense that it will be, when it does begin to cut, it won't be because we're moving to a recession, but rather that we're at a point where enough is enough in terms of the tightening cycle, and they'll give 1 or 2 cuts in, and it begins a process. But to expect, going back to a band of 0 to 0.25, that's an emergency kind of Fed funds band. 5 to 5.25 looks pretty realistic right now based on the stickiness of inflation.